What does it actually take to go from zero to $1 billion in property? Not the highlight reel version, not the stage clip where someone holds up a fake check. The actual mechanics, the spreadsheet at 1 a.m., the first check that clears and almost doesn't. You're about to watch that climb happen level by level, the way it really works, starting from the exact bottom rung nobody posts about. Level 0. This is where every fund, every empire, every name you'll eventually see on a building actually begins. Not with institutional capital, not with a term sheet. With 47,000 sitting in a savings account, most of it yours, some of it borrowed from a brother-in-law who still brings it up at Thanksgiving. You didn't start with a fund, you started with a duplex. Here's the question you had to answer before any of this could happen. Why real estate at all? You'd watched people try to build wealth in the stock market, and the math worked, technically, but it felt like sprinting on a treadmill bolted to the floor. No leverage a bank would hand you for free. No cash flow you could touch monthly while you waited for appreciation. You'd watch crypto make people rich on a Tuesday and broke by Friday and decided you didn't have the stomach or the luck for a coin flip disguised as an asset class. Real estate was different. It was the one asset a bank would let you control 80% of while only putting up 20% yourself. It paid you rent while you waited. It came with a tax code that seemed to have been written by someone who liked landlords more than salaried employees. Real estate wasn't the sexiest vehicle. It was just the one where the rules were tilted in your favor if you were patient enough to learn them. So you went looking for the first property, not the one you'd brag about. The one that would teach you the mechanics without bankrupting you if you got something wrong. You found it on the 4th week of driving neighborhoods on Sunday mornings, the way nobody tells you real investors still do. A duplex, brick, built in 1974, 2 units, tenant already in place on one side paying $950 a month, the other side vacant and smelling like cigarettes from a previous life. Asking price $210,000, you ran the numbers 3 times because you didn't trust yourself to run them once. Rent roll against the mortgage, vacancy assumption at 8%. Repairs reserve you probably underestimated because everyone underestimates that number the first time. You called it underwriting because you'd read that word in enough places to know it made you sound like you knew what you were doing, even though what you were really doing was math with a lot of fear attached to it. You closed with a conventional loan, 25% down, most of that $47,000 gone in a single wire transfer that made your stomach drop the second you hit confirm. Closing day, you stood in the empty unit holding keys that felt heavier than keys should feel, and nobody was there to tell you what came next. No mentor, no fund, no team, just you, a lease template you downloaded from a forum, and a leaking faucet in Unit B you'd have to fix yourself because paying a plumber $140 felt like a crime against your remaining bank balance. This is where the real education happened, not in the underwriting, in the operating. You learned that a tenant who pays on the 1st every single month for a year will call you at 11 p.m. on a random Tuesday because the garbage disposal is making a sound like a dying animal. And you will drive over there because you don't yet have a property manager, and the alternative is losing a good tenant over 60 in parts. You learned the difference between gross rent and net operating income the hard way, watching a number on paper shrink every time a water heater failed or a unit sat empty for 3 weeks longer than your spreadsheet had promised. You learned that cash flow isn't a concept. It's the amount left over after every single surprise the building throws at you, and buildings throw a lot of surprises. Somewhere around month 7, something shifted that you didn't notice happening in real time. You stopped thinking like someone who owned a duplex and started thinking like someone who managed an asset. You started tracking cap rates on properties 3 streets over just to see how your building compared. You started asking the property manager down the block what he charged and what he'd charge for 2 doors instead of 1. That's the mindset shift nobody warns you about. The buyer thinks about 1 deal. The fund manager thinks about the next 10 deals before the first one has even stabilized. That shift is what made you set up the LLC before you technically needed one. Your accountant told you it was overkill for a single duplex, and maybe it was, but you weren't setting it up for the duplex. You were setting it up for the version of yourself that already believed there'd be a second property, then a 5th, then 30. You separated the entity from your personal name because somewhere in the underwriting spreadsheets and the late-night forum reading, you'd absorbed the idea that funds aren't built on personal ownership, they're built on structures. Clean legal walls between you and the asset. A framework other people's money could eventually sit inside without touching your name directly. You didn't call it a fund yet, it was one LLC holding 1 duplex with your name buried 3 layers down in the paperwork. But the bones were already there, the entity, the separation, the beginning of a system instead of a purchase. Level 0 isn't glamorous. There's no press release for a duplex with a leaking faucet. But it's the level where you learn the only things that actually transfer to $1 billion later, how a lease works, how a tenant thinks, how a number on a spreadsheet either lies to you or tells you the truth depending on how honest you were when you built it. Every level after this one just adds zeros to lessons you already paid for here, in cash, in sleep, in a stranger's garbage disposal at 11 p.m. on a Tuesday you'll never fully forget. Level 1. The duplex is stabilized now, cash flowing $380 a month after everything, and you've got a second property under contract, a fourplex this time, $410,000, and here's the problem nobody warns you about when you're staring at your own bank statement. You've hit the ceiling, not the ceiling of ambition. The ceiling of capital. Your $47,000 is long gone, recycled into a down payment and a new roof and a plumber you finally paid instead of becoming. Whatever's left after 18 months of cash flow and careful living is maybe $31,000 and the fourplex needs $102,000 down. The math doesn't close. You either stop here or you learn to raise money that isn't yours. This is the moment every real estate empire either happens or doesn't. Not the first deal. The first check that comes from someone else's account. You start with your brother-in-law again because he's still bringing up the duplex at Thanksgiving and you'd rather he brag about being early than needle you about the loan. He puts in $25,000. A coworker's dad, retired, sitting on a rollover IRA doing nothing, puts in $40,000. You cobble together $95,000 from 4 people who trust you more than they trust their financial advisor, and you close the fourplex. And in that moment, without fully realizing it, you've become something new. You're not a landlord anymore. You're a sponsor. And you're about to learn there's a very real difference between doing that once and doing it as a business. This is where you have to understand the distinction that trips up almost everyone at this level. A syndication deal is one property, one raise, one group of investors tied to one asset with one exit. You raise for the fourplex, you close, the deal lives and dies on that single building's performance. A fund is different. A fund raises capital first, blind to the specific properties, and then goes and buys multiple assets inside that same pool of money. Syndications are what you do when you don't have a track record yet. Funds are what you build once you do. You're not ready for a fund. Not yet. You're doing your third and fourth syndications, one deal at a time, each one a proof point, each one a rung on a ladder that's slowly turning into something that looks like credibility. By property number 5, a small strip retail center you picked up for $650,000, you've raised outside capital 4 separate times and returned every dollar you promised on time with distributions that actually hit people's accounts on the 15th like you said they would. That track record is the actual currency here. Not your pitch, not your charisma, not your deck. The track record is what lets you walk into a room with a stranger's money in it instead of just family and friends. This is where GP and LP stop being letters you read in a forum post and start being the actual architecture of your life. You are the general partner, the GP, the one who finds the deals, signs the loan, manages the asset, loses sleep when the roof leaks. Your investors are limited partners, LPs, capital in, distributions out, no operational say, limited liability, limited upside relative to you because you're the one carrying the risk they never see. You start charging an acquisition fee, 1% of purchase price, small enough nobody blinks, real enough that it starts covering your gas money and your spreadsheets. You structure a preferred return, 7% to your LPs before you take a dollar of profit above that, and then a split above the preferred, 70-30 in their favor at first because you need them more than they need you. That 30% on the back end is your carried interest, the thing that turns a manager into an owner of upside, the thing that, multiplied across enough deals and enough years, is the actual mechanism by which fund managers become wealthy instead of just busy. Somewhere around deal 6, you build your first real pitch deck because you finally got enough of a story to put on slides instead of just telling it over coffee. Track record page. Rent roll comparisons. A team slide with exactly one photo of yours because there is no team yet, just you and a property manager you finally trust. You send it to 11 people. 4 say yes. That's the first time a stranger, someone who's never met your brother-in-law, someone who found you through a referral 3 degrees removed, wires you $50,000 based on a PDF and a phone call. That feeling doesn't leave you. It's the first proof that this can scale past people who already love you. And this is exactly the point where you have to stop moving fast and start reading carefully, because the SEC doesn't care how good your deck looks. You learned the phrase accredited investor the hard way, reading Reg D filings at midnight instead of sleeping. $200,000 in annual income or $1 million in net worth excluding your primary residence, that's the bar most of your early LPs need to clear under a 506B exemption, the one that lets you raise from people you already have a relationship with without advertising publicly. You file your first Form D, you add subscription agreements that used to be a 2-line email between friends, you hire a securities attorney for $4,000 you didn't want to spend, and he saves you from a mistake in the offering memorandum that could have cost you the entire fourplex raise in penalties alone. By the time you're holding 7 properties, some duplexes, some small multifamily, 1 retail strip, all under separate LLCs but with the same LP base rotating through each deal, you're not really running syndications one at a time anymore. You're running a portfolio with a repeatable pitch, a repeatable structure, a repeatable set of people who trust you with the next check before you've even found the next building. That repetition, that's the bridge. Level 2 isn't a bigger deal. It's the moment raising capital stops being an event and starts being a system, the exact system a real fund will eventually be built on top of. Level 3. You cross $50 million in assets under management somewhere in year 4, and nobody hands you a plaque for it. There's no bell to ring. You just notice one Tuesday that the spreadsheet you built in year 1, the one with color-coded tabs for each property, has become genuinely unusable. 17 assets, 4 states, 12 different LP groups with overlapping but not identical stakes in each one. You're still the guy answering every investor email at 11 p.m., still the guy who drives out to look at a roof personally, and the cracks in that model aren't cracks anymore. They're the whole foundation shifting under you. This is the threshold nobody explains properly. Somewhere between $50 million and $100 million, the business stops being you with helpers and starts needing to be an actual company, whether you're ready to build one or not. The thing that got you here, the hustle, the personal touch, the guy who remembers every LP's kid's name, that thing cannot scale past this number. Not because you're not good enough, because there are only 24 hours in your day and the fund doesn't care. So you hire, really hire, for the first time. Not a bookkeeper you pay by the hour, a director of acquisitions, someone whose entire job is underwriting deals you'll never personally walk through before the LOI goes out. You bring on an asset manager next, someone who lives inside the operating performance of the portfolio the way you used to, freeing you up to do the thing only you can do, which is raise the next round and keep the relationships that got you here. Then investor relations, because LPs who used to get a phone call from you now get a quarterly report from a person whose entire job is making sure that report is accurate, on time, and doesn't read like it was written at midnight by someone who also fixed the garbage disposal that morning. 3 hires. 6 figures a year combined, before you've even touched marketing or compliance. It's the first time payroll scares you more than a bad inspection report ever did. And here's the part that actually changes the shape of the business. You stop buying what you know. Up until now, it's been multifamily, mostly in your own backyard, because that's the market you can drive to and the asset class you can underwrite in your sleep. At this size, that concentration is the risk. One municipality changes its rent control policy, one regional employer relocates, and your entire fund feels it at once. So you diversify: industrial flex space in a market 2 states over, a grocery-anchored retail center in a metro you've never lived in, self-storage in a Sunbelt city growing faster than its own zoning can keep up with. You're not doing this because it's exciting. You're doing it because a fund with 17 assets in one submarket isn't a fund. It's a bet, and bets get wiped out. Spreading across property types and geographies is how you turn a bet into a portfolio. The same way a stock picker eventually has to admit that concentration is genius on the way up and a disaster on the way down. This is also exactly when the type of money chasing you starts to change. Your first LPs were people: a brother-in-law, a retired IRA, a dentist who found you through a podcast. Somewhere past the $75 million mark, you get your first call from a family office, quiet money managing generational wealth for one household, no fanfare, no logo you'd recognize, just a due diligence team that asks questions your college buddy investors never thought to ask. Then a small allocation from a regional pension fund, the kind of capital that comes with an actual investment committee, a 50-page due diligence questionnaire, and a mandate that requires you to prove in writing that you can deploy at scale without losing discipline. Institutional money doesn't care about your story. It cares about your systems. And the moment you win your first institutional check, you realize retroactively that everything you built in the last year, the hires, the reporting, the diversification, wasn't really optional. It was the entry fee for a room you didn't even know you were trying to get into. Leverage changes too at this size in ways that would have terrified you 3 years ago. Early on, debt was simple, a conventional loan, personally guaranteed, sized conservatively because you had no room for error. At scale, you're structuring debt at the portfolio level, not just the asset level, negotiating with regional banks and debt funds and sometimes life insurance companies for terms that would have been unthinkable when you were buying duplexes. You start using a genuine debt strategy instead of just accepting whatever rate you're offered, layering in fixed and floating structures, staggering maturities so you're never facing a wall of refinancing risk in a single bad year. Leverage stops being a tool that lets you buy the next property and becomes a lever you actively manage across the whole fund, the difference between a mechanic who can fix an engine and one who designs it. None of this works without systems you didn't need before. Quarterly reporting that used to be a friendly email is now a formal package, audited financials, capital account statements, compliance filings that a securities attorney reviews before anything goes out the door. You bring in fund administration software because a spreadsheet, even a good one, cannot track capital calls and distributions across 100+ LPs without someone eventually finding an error that costs you a relationship. Compliance stops being a box you check once during formation and becomes an ongoing discipline, because institutional LPs will walk if they smell sloppiness. And sloppiness at this size isn't a rounding error, it's a lawsuit waiting for a trigger. And then the cycle turns, because it always does. Somewhere in this stretch you live through your first real downturn as a fund manager instead of a landlord. Rates spike, cap rates move against you, a property you underwrote at a 6% exit assumption is suddenly facing an 8% environment, and LPs who've never lived through a cycle start calling with the kind of questions that used to be rhetorical. This is where the diversification, the debt structuring, the reporting discipline, all of it either proves itself or doesn't. The funds that survive a downturn aren't the ones that avoided risk entirely. They're the ones that built the operational spine early enough to bend instead of break. You come out the other side smaller in paper value for a stretch, but larger in something harder to put on a balance sheet, the trust of LPs who watched you manage a bad year honestly instead of pretending it wasn't happening. That trust is the actual asset that gets you to the next level. Not the buildings, the believability. Level 5. $1 billion. You say it out loud once alone in the parking lot after a closing, just to hear how it sounds, and it sounds fake, like a number from a press release about someone else's fund. But the wire confirmations are real, and the org chart on your desk now has 41 names on it, and somewhere in the last 18 months, you stopped being the founder of a real estate fund and became the CEO of an institution that happens to own dirt and buildings. Here's what nobody tells you about this level. It doesn't feel like winning. It feels like running 6 businesses at once wearing the same pair of shoes. You've got an acquisitions team sourcing off-market portfolio deals across 4 regions simultaneously. A development arm breaking ground on a 400-unit build-to-rent community you'll never personally walk the framing on, an asset management division running daily operations on properties you sometimes forget you own until the quarterly package lands on your desk. You used to know every roof by name, now you know every roof by its position in a capital stack. The deals themselves change shape entirely at this size. You're not buying a duplex anymore or even a 17-property regional portfolio. You're buying entire platforms. A regional operator with 2,200 units and a management team you're inheriting whether you like them or not. A ground-up mixed-use development that takes 3 years and $180 million before it produces a single dollar of rent. A sale-leaseback on an industrial portfolio where the tenant is a Fortune 500 logistics company and the lease itself is the asset more than the concrete. You start thinking less like a buyer and more like an allocator, deciding not which building to acquire but which strategy deserves the next 100 million, development or acquisition, coastal or sunbelt, stabilized yield or value-add upside. The math gets bigger, but the discipline that got you here, the same discipline from the duplex years, still has to hold or the size just means you fail louder. And here's the part that surprises you most. Past a certain size, the deal flow stops being something you chase. It comes to you. Brokers who wouldn't return your calls in year 2 are now calling you first before the listing goes live, because your fund closing on time every time has become a known quantity in rooms you're not even in. Your name on a letter of intent means something to a seller's attorney now, a signal that the deal won't die in due diligence over financing that falls through. That's the actual product at this level, not the buildings. The reputation, capital is everywhere at this size. Trustworthy capital that closes what it says it'll close is not, and that scarcity is what puts you at the top of the stack in a bidding process instead of the middle. The investor base has changed shape too, one more time. The family offices and the small pension allocation from level 3 have been joined by sovereign adjacent capital, insurance company balance sheets, endowments with mandates measured in decades instead of quarters. These aren't LPs anymore in the old sense. They're partners with seats, sometimes literally, on an advisory board that reviews your major decisions before you make them. And they want 2 things that pull against each other constantly. They want their distributions on schedule, predictable, the yield they modeled when they signed the subscription agreement. And they want you to keep growing the fund, keep deploying, keep finding the next platform, because growth is the other half of why they wrote the check. Balancing those 2 demands, paying people out today while reinvesting for tomorrow, is the actual full-time job now. You have a treasury function inside the fund just to manage that tension, deciding what gets distributed and what gets recycled into the next acquisition, and getting that balance wrong in either direction, over-distributing and starving your pipeline, or over-retaining and starving your investors, is quietly how funds this size lose the trust it took a decade to build. Because funds do collapse before they get here, and almost never for the reason outsiders assume. It's rarely one catastrophic deal, it's usually slower than that. A fund that scaled its assets under management but never scaled its systems, still running institutional-sized capital through a reporting process built for year 2 LPs. A fund that chased size for its own sake, taking capital it didn't have the pipeline to deploy responsibly, sitting on dry powder while paying management fees on it, which is its own quiet form of theft against your investors. A fund that let concentration creep back in because one asset class was working so well, nobody wanted to diversify away from it right up until that asset class stopped working. Or simplest of all, a fund whose founder never let go of being the smartest person in every room, never actually built the team, and hit a ceiling made entirely of their own bandwidth. The ones that make it to $1 billion aren't the ones that never had those temptations. They're the ones that built the guardrails early enough that the temptations never got to decide anything. Which brings you back, standing in that parking lot with the wire confirmation still open on your phone, to the through line that's been there since the first duplex. Every level from 0 to 5 was the same lesson wearing a different costume. Underwrite honestly even when the market doesn't reward honesty. Build the system before you need it, not after it's already failed you. Treat other people's capital like it's worth more than your own reputation, because eventually it becomes the only thing your reputation is measured against. The dollar amount changes by a factor of 1,000 between level 0 and level 5. The discipline required to get there doesn't change by a single degree. If you're still at level 0, still staring at your first deal wondering if any of this is even possible, that's exactly where every billion-dollar fund started. One property, one honest underwrite, one investor who trusted you before you'd earned it. Build the spine early. The size takes care of itself. That's the whole game, level by level.